Welcome back to another episode of Trading for Beginners. Last week we started focusing on risk management by looking at how we choose our position size. So I taught you how to calculate what we call our dynamic position size. If you watched that video, you'll remember that part of that calculation depends on where you'll be exiting your trade, which can be done by using a stop loss. And that's what we'll be talking about in this episode. Before we get started, I just want to remind you that this series is going through things that apply to many different ways of trading. But if you want to know more about how I trade specifically, you can learn more about the Duomo method in our free course, which is linked down below. In last week's video, someone left a comment saying that as a beginner, you wouldn't know what is or isn't a good opportunity. And that means you wouldn't know how much you should put at risk for a trade. So therefore, it's better to stick with a static position size. Now, I do think that that person is right to a certain extent, that as a beginner, you won't know how to do the things that you're learning now properly, but I don't think that's an excuse to learn a bad habit instead. I'd rather you learn things the right way now, so that when you do have the rest of the required knowledge, you already know how to execute your trading correctly, rather than just learning a bad habit now that will only need to take time and work later on to correct and learn the right way, so it serves no purpose. With that in mind, some parts of this lesson about stop losses will be about things that you haven't mastered yet. Since you don't necessarily know how to assess trading opportunities, we haven't covered that so far. But that's fine, because we'll come on to that in good time, and you'll be able to then re-watch this lesson if needed, if you can't remember the things that we've discussed. But risk management is a vitally important part of trading, and I want to make sure that you learn a correct way right off the bat. So let's start off with what a stop loss is. When we open a trade, as you'll know from the previous lesson, we want to know where we're going to be exiting the trade to limit the amount of money we can lose if the price moves against us. You can do this manually by just closing the trade yourself when it reaches a particular price, but then that presents a whole load of other potential problems, such as your loss aversion kicking in, where you don't actually want to have a loss on your account, so you try to avoid taking one, which usually ends in disaster. Or you could potentially miss the time that you wanted to exit and end up having a bigger loss because you didn't trigger it at that time. So instead, to avoid these problems and many other problems, we can use a stop loss. This is an order that we place with our broker that will automatically close the whole trade or part of the trade at a particular price in the market. You choose this price point ahead of time, and if the price does reach that price level, then in most cases it will be triggered automatically. Now, there are things such as slippage, which is something we'll talk about another time, and a lot of people are afraid of something known as a stop loss hunter, and that's something we'll cover at another point in time instead. But as this is a Trading for Beginners series, we're just going to stick to the basic concept of a stop loss, when to use it, and why we use it. In an ideal situation, our exit point for a trade will be at the so-called sweet spot, where it's just right for the opportunity. Not too close to the entry that it strangles the opportunity and doesn't allow the price to fluctuate around before eventually heading into profit, and not too far from the entry that you're just losing extra money unnecessarily when an opportunity is already lost. As you might imagine, it's not going to really be possible to hit the sweet spot with your planned exit point on every single trade, but if we approach it in the right way, we can get ourselves much closer to that. So just like in the position size video, let's go through some common approaches for placing a stop loss that are wrong, and then we'll cover a better approach that you can start using from today. The first common method is a static stop loss. This is similar to a static position size that we learnt about in the last episode, and basically this is where you'd be using the same stop loss for all of your trades. I'm ashamed to say that when I first started learning, I did something very similar to this. I would have a stop loss of around 30 pips for practically every single trade, but it's not the right way to do it. If you do this, your stop loss isn't based on the opportunity at all. You're very unlikely to be hitting the sweet spot with your stop loss. Instead, sometimes the opportunity will need a wider stop loss, and your static stop loss will be strangling the opportunity. And at other times, the opportunity might need a much tighter stop loss, and you'll just be giving away extra pips in loss back to the market that were just unnecessary. The next common method is to try to enforce a static risk-reward ratio. You see, some people will already have decided that they want all of their trades to be something like a 1 to 3, where they're risking 1 to earn 3. And that's great, it's a good idea. But then rather than finding opportunities that represent that ratio, they'll force it instead. They'll look at an opportunity and maybe think to themselves that they have potential to make 60 pips profit. So therefore, since they want it to be a 1 to 3 trade, they'll set their stop loss at 20 pips to make it a 1 to 3. The outcome of this is very similar to a static stop loss. It's the same principle. The stop loss position is being adapted to the overall opportunity in terms of numbers, but not in terms of context. And context is what matters. It's the only way you're going to be able to hit the sweet spot, unless it's like a broken clock that's correct twice a day. You don't want to have that situation, you'd be relying too much on luck. So instead, this is how we should correctly choose our exit point and stop loss. It should be based on the opportunity itself, not just the entry point and then figuring out a 3 to 1 there, but the entire opportunity. In the first episode of this series, we discussed the context of the market, and we discussed how that is the basis of our trade entries and our trade management. When we find a trading opportunity and we open our trades, what we're basically implying is that we've looked at the context of the market and we can see that taking into account the possible downside and the possible upside, there's a chance to make a profit. And we'll get into more detail about what it means to make a profit in a future episode. So what we're saying with all of this is that by looking at the context, we can already see where the price is likely to go in either direction while staying within that current context. We also know where the price will need to move to or break through if it was going to break that context as well. So let's go back to our waves, our price structure from that very first lesson, so that I can explain all of this with an example. Now, it's important to note, I'm not saying that you should base all of your decisions on the price structure. That wouldn't be the right thing to do. It's just that this is an easy way for you to be able to understand how context is the important part in deciding when to enter or exit a trade. So imagine we have our waves in the market like this. It's an uptrend with higher highs and higher lows. And we decide to enter a long trade here. That means that we're going to make a profit if the price continues moving up. We want that bullish trend to continue. So in this case, we know that as long as we get more higher highs and higher lows, the bullish structure is continuing. So within the current context, we know that it's 12 pips to the previous higher low, and if we break through that, we'll now have a lower low and the context will change. We also know that it's 36 pips to the previous higher high. And if we don't manage to break through that, it will mean that we then have a lower high, which also changes the context. Right now, based on this really simple framework, we can see that within this very basic context, the price can fluctuate between 12 pips in loss and 36 pips in profit without even changing the context of our analysis. Therefore, if we think the potential success rate of pushing through to the top of that wave and maybe even beyond looks good enough, we would enter the trade. We'd put our stop loss based on the 12 pips, since we know if it pushes through that point, the context would have changed, and in this very simple scenario, that means we wouldn't want to be in the trade anymore. So beyond that point, it's no longer showing the reason why we opened the trade in the first place. The context would have changed, and that's not the context of our opportunity. Now, I have to reiterate again, because I know there'll be some know-it-alls in the comments helping people, really just trying to show off how much they know. This is just a simple example and not how you'd base things in real life. In real life, your stop loss wouldn't be exactly at 12 pips. You'd probably give it a bit more room. And in real life, your analysis of the context will be much more complex and based on the particular trading approach that you're using, not just on the waves and the price structure. The purpose of this example is to take something that we learned already 2 lessons ago and use it to help you understand the concept of placing your stop loss based on the opportunity and the context. So we can see in this case that the trade was a 1 to 3. You're risking 12 to make 36 and maybe even more. So that's the equivalent of risking 1 to make 3. It's a 1 to 3 based on the actual opportunity though. We haven't chosen our stop loss at a particular price point just to force it into being a 1 to 3. So imagine instead of using the price structure, you are basing the opportunity on some levels or whatever else that's provided by the system that you're trading. Whatever tools or analysis methods that you end up using, it might point out that if the price breaks past a certain important level on your chart, the context has changed and it's no longer the same opportunity. So that's what you'd be basing your stop loss on. Regardless of how much profit the opportunity is set to make, your stop loss is going to be based on that. And when you look at the potential profit from that compared to the potential loss, both of which are based on the opportunity and the context, that's how you can start to decide if the trade is viable when you take into account the success rate. So that's what we need to keep in mind. The context and the opportunity dictate where our stop loss should be and our realistic estimate of the potential profit within that context. By figuring out those aspects and then estimating the chance of succeeding, we can see if it's a viable trade entry for us. But don't worry, we're going to come on to trade entries and how we can make these sort of decisions in a future episode. For now, I want you to do an activity. I want you to take the price structure activities that you were doing from the first episode, mapping out the waves in the market, and then I want you to replicate the example that we just went through just now with the stop loss and potential profit, based on these simple waves that you're mapping out in the market. Just choose a random entry point and then figure out the stop loss placement if you were entering a trade there. Once you know where the stop loss would be, try to decide based on the context of the market how strong the situation is. Is the structure strongly in your favor or is it not? Based on that, you can start doing the calculation that you learned in the last episode for a dynamic position size. And at this point, you're going to know the basic context of the situation, you'll know what trade size you'd be opening, and where your stop loss would be. In some of the next episodes, we'll start to improve how you analyze the context so you can start to find some real opportunities in the market. But until then, don't forget to leave a little like on this video, hit the thumbs up button, and subscribe to the channel so you don't miss our future episodes of this series. And of course, if you want to learn more about the specific way I analyze the markets and trade, you can get started with our free introduction course, which is linked down below in the description box. Thanks a lot for watching. See you next time.